today I'm going to be looking at Warren Buffett's 5 top pieces of advice for investing. And then I thought it'd be interesting to look how they apply to property. Because as we know, Warren Buffett is currently the 5th richest man in the world. He's seen as many as the grandfather of investing, the wise old man that everyone turns to for investing advice generally in the world. So what can we learn from his investing advice and take that advice and apply it to property? So that's what we're going to be covering today. He says the first rule of investing is don't lose money. And the second rule of investing is don't forget rule number 1. That's how important he thinks this is. So why is this important? I think it comes down to essentially if you lose money in investing, you need to work doubly hard to make up for it and get back to where you were before in order to make some returns. There's a couple of phrases in English which sum this up very well, which is a pound saved is a pound earned, and a bird in the hand is worth 2 in the bush. So in order to make money, you shouldn't lose money because you're going to have to work harder and harder to get to where you want to be. So how does this relate to property? Well, I think firstly, as I always kind of bang on about, you need to do your due diligence on the property you're buying in order not to lose money. You need to be buying the property in the right area. So an up and coming area that's going to make you money in the long term. You need to buy it at the right price, ideally below market value. You need to ensure you've done your numbers right. Does the property wash its face? Does the rental income cover all of the outgoings that you've got on that property and then make you a profit on top of that? Because if it doesn't, you're essentially going to be making a loss every month, and obviously that goes against his rule. So you need to ensure that you've done your due diligence as well on the property itself. Is it structurally sound? How much is your refurb going to cost you? Is there any legal problems? Because all of those, if you get them wrong, if there's something missed, can cost you money. As well as doing your due diligence, you need to ensure that you're picking the right strategy and that you have multiple exits on every deal. So for example, if you're looking at a flip deal, does it work for anything else? Or does it only work as a flip? Because if it only works as a flip, you're putting all your eggs in one basket, you're really increasing your risk, and it's very easy to get burnt on a flip deal. So for example, the refurb may go over budget, the refurb may go over its timelines, or if there's a dip in the market and you cannot sell the property, or you have to sell it way under the price that you want to sell it for, and therefore you might not actually make any money, you might actually make a loss. But if you actually had other exits on that property and other strategies, which could also be your plan B, C, and D, so could you keep it as a buy to let, for example, that means that you are less likely to lose money on it, and you're managing your risk by having other options. And that's what I mean by exits. Essentially, it's having other options. What's your contingency plan if things go wrong? And of course, it applies for every deal and not just flip deals. Another way not to lose money in property and to manage your risk is to diversify. And you can apply the diversification principle in a variety of ways. So you could apply it to your strategy you're picking. So diversifying away from just one strategy. So for example, if your portfolio is just full of student HMOs, for example, and then there's a legislation change around student HMOs, that impacts 100% of your portfolio. But if you've got some properties that are HMOs, service accommodation, buy to let, for example, then if you've got legislation change around HMOs, that's potentially only going to affect 30% of your portfolio. And you can look at diversity of area as well. And this is where, again, you're not putting all your eggs in one basket. You're not investing all in the same kind of town, for example. You're investing in a variety of different towns, because then that gives you more tolerance if something happened into that town, to that local economy, like, you know, a big employer moved to China or somewhere like that, for example, that, you know, that's happened in the last 30, 40 years in this country. So just spreading your risk out through spreading your locations out a little bit. So that's diversification. I think another good tip to not lose money in property is don't panic when things go wrong. So whether there is a market crash, whether you can't sell the property you're looking to sell in a flip scenario, it's very easy to panic in those situations and make the wrong decision. I know someone who purchased a property. They bought it from someone who panicked after Brexit So they thought that the market was going to completely disintegrate, and this was in London. They thought the market was going to collapse after Brexit. So they sold the property at a cheap price to my friends. What's obviously happened in the preceding years is that property's gone up in value. The market has never crashed because of Brexit. And who's the real winner there? And who's the loser in that situation? So don't panic sell is definitely a good piece of advice in this scenario, is not to lose any money. And as I always say, property is a long-term game, and actually the real benefits come from holding on to that property. So unless you've got a specific strategy for selling, then ultimately it's best off to hold it, and that's where you'll get the real gains, and that's where you'll actually even out any ups and downs and turmoil in the market that comes and goes. I think it's worth noting as well that actually point one follows all the other points. So all the other points kind of feed into not actually losing money. So point number two is be patient. And Warren says, the stock market is a no-called strike game. You don't have to swing at everything. You can wait for your pitch. Really what he's saying here is that investing is a long-term game, stock in market investment particularly, because the stock market fluctuates, it goes up and down. As you can see from this graph, there is a long-term trend upwards, but you only get the benefits of that if you hold on to your stocks, weather the storms, weather the troughs, and then wait for the peaks in the long term. With any long-term investment vehicle, don't expect to get rich overnight. In fact, Warren Buffett has said that he's willing to wait 10 years or so for an investment to pay off, and potentially longer depending on the type of investment. Property has grown 3.7% since the 1950s in the UK, and there's been many market fluctuations, dips and peaks over the last 50 years in the UK market. But like the stock market, the trend is upwards and the market always recovers. And it's worth considering the 18-year property cycle here to really help deepen your kind of knowledge around it. And that's a whole nother video in itself, and I will do a video on that. But the 18-year property cycle essentially says that the property market goes through certain stages over an 18-year period, from a crash to recovery to growth, and then to sort of hyper growth, and then crashes. And it goes through in that cycle every time. And that's a concept that's actually been modeled out over the last 200 plus years of property data in the UK. The reason it's so important is because it provides a framework with which to understand the property market, and to understand that for every crash there will be a recovery, and there will be a explosion and growth, and for every growth and explosion there will be a crash. And it's just a cycle, and it just repeats. And in fact, what I would even say is that property, like stock market investing, is actually quite boring. Not really much happens once you've acquired the property and you're letting it sit there. Once you've acquired a property, just let it do its thing over time and just kind of ignore it over 20, 30 year period. So Warren's point number 3 is diversification. And he says, diversification is protection against ignorance. It makes little sense if you know what you are doing. So a slightly cryptic message from him there, but what he means is that it's best to diversify in order to manage the risk if you've got some things wrong. Diversifying is the simplest way of ensuring that you will win, and one of your bets will win over time. Essentially what he's saying is it's a bit of a numbers game. So instead of betting all your money on one horse in your horse race, for example, you spread your bets across 10 horses, and that means one of them's going to win and one of them's going to provide you with a return. And that's essentially what he's talking about. And that's what diversification is, not putting all of your eggs in one basket. If one of those different asset classes crashes, you've still got the protection and the returns from those other two classes, or however many classes you're looking at. So how does diversification relate to property? Well, I've covered some of that already, but you can diversify in terms of your strategy you're picking. So you've not just got all of your eggs in the HMO basket, for example. You can diversify through spreading your capital across multiple properties rather than putting it in just one. And then you're obviously benefiting from the power of leverage as well if you're spreading out your funds in a leveraged way using 25% deposits, it means that if there's an issue with one of those properties, you've still got the others to keep you afloat. Diversification in property helps to reduce your risk. It helps to protect you from any downturns in markets, any unforeseen circumstances, things like pandemics, any legislation changes that you couldn't have foreseen, any downturns in areas, and protects you from any black swan style events such as a pandemic, wars, energy crisis. Because if we look at energy crisis, which is obviously a hot topic over the last few months and years. So if someone had a wide range of properties in their portfolio, then if you had something like an energy crisis, you might only have a percentage of properties impacted, and then the rest of them would be able to protect the downside and the fall in income from those ones that have been impacted. So point 4 is invest for the long term. Warren says, the stock market is a device for transferring money from the impatient to the patient. What a fantastic quote that is. I'm going to read it again. The stock market is a device for transferring money from the impatient to the patient. And this is why this man is the grandfather and the guru of investing for quotes like that. So as we know, the stock market fluctuates in the short and medium term, but has an upward trend in its history of growth. And therefore, it's got to be treated with a mindset of it being a long-term game and a long-term investment vehicle. So therefore, you need to be patient. We know that there will be volatility and there will be crashes and there will be ups and downs, and that's all part of the cycle and all part of the game. And therefore, it's important not to panic when those downturns do happen, and trust the process. Trust that you know it's part of the cycle. It's an inevitable part of the cycle. The market will always recover because we have 150 years plus of data to go off. So how does this relate to property? Well, as we know, property should be viewed through this lens too. It is very much a long-term vehicle. The real wealth in property is created over a 30 to 40 year period. You get paid twice in property. As I always say, you get paid from the rental income that should be giving you a net profit every month and the capital appreciation over the long term. Both of those things together will compound, and we know the power of compounding is the seventh wonder of the world, as Einstein said. So you need to trust the process of compounding, the power of leverage, safe in the knowledge that your property will grow over time, you will get the capital growth, and all of those things together will create that financial security and that wealth that you're looking for. So number 5 is don't try to time the market. So this is one of Warren's most famous sayings, which is, it's not timing the market, it's time in the market. And what he says here is that it is virtually impossible, even he doesn't know, when the market will go up, when the market will go down. We know it will do both of those things. As we talked about earlier, we know that it will fluctuate and it's all part of a cycle and a process. However, trying to predict exactly when that will happen is virtually impossible. So his advice here is don't try and time your investments. Don't try and actually beat the market. Don't try and beat, Mother Nature or whatever is controlling the ups and downs in the stock market, because you won't be able to do it. And how does it relate to property? Well, it's very, very similar advice here. Just looking at the data, we know the property market will go up and it will go down. And that is as predictable as the sun rising in the morning. We know it's going to happen, we just don't know when. So actually trying to predict it and trying to time it and trying to time your investments to potentially buy when the market's crashed or sell when the market is up is virtually impossible. And that's why a long-term viewpoint is really key here. And obviously all of these points relate together, because with your long-term mindset, you kind of will start to ignore the short and medium-term fluctuations in the market. If we look at the kind of property market, there's been so many examples over even the last 10 years. We've had so many predictions of crashes that I can remember, and it's not actually happened. So there'll be a lot of people there waiting for that crash to happen, and they will have missed out on lots and lots of opportunities. But if they'd taken Warren's advice, which is to invest consistently and forget the ups and downs of the market, they could have utilized those opportunities that were out there. It's better to invest now than wait for that special moment, that crash, that market peak, because you're very much on to a losing battle. I've actually got a special bonus for you, which is actually Warren's 6th piece of advice, which is invest in yourself. So he says the best investments you can make is in yourself. Learn new skills, take on new challenges, and grow your knowledge. So what he's talking about here is, in order to have the best mindset, in order to be able to cope with, I suppose, the stresses of investing and the complexities of investing, you need to be the best version of yourself. You need to be in the right frame of mind. You need to have the right mindset. We've talked a lot about mindset today, having a long-term mindset, having an investor's mindset, having a disciplined mindset. And you can't get all of that without investing in yourself, without surrounding yourself with positive people, and, as I said, being the best version of yourself. And he also talks about this in terms of knowledge as well, because you need to understand what you're investing in. And in fact, without knowing what you're doing, you're actually likely to lose money, which is point number 1, don't lose money. And in terms of knowledge around property, there's some key things that you need to understand: how to do your due diligence, understanding the power of leverage, having that long-term view, understanding investment figures, how to read deal sheets, how to understand all the different terminology, and to be able to manage people and processes in order to get the best investments and the best returns. And I think a lot of Warren's advice, the reason I think it resonates with so many people, is that it's actually quite common sense advice. However, as we know, not everyone follows common sense advice because people feel that they know better. And of course, this is one of the most successful investors ever, the 5th richest man in the world. So if you're not going to listen to him, well, who are you going to listen to? So I'll leave you with another classic Warren Buffett quote, which is that risk comes from not knowing what you are doing. So make sure you get educated, you keep learning, you stay disciplined, and this will help you succeed in property investing and be more like Warren Buffett. So good luck. If you've enjoyed this video today, please do like it, and please do add any comments. I'd love to hear your key takeaways and learnings from this, or any questions. And please do subscribe to our channel for more content in the future. It really does help us grow, and all your support is much appreciated. So thanks very much.